JonathanAKnee, the accidental investment banker, inside the decade that transformed Wall Street. Welcome to the intriguing world of investment banking during the heady days of the 1990s, as chronicled in JonathanAKnee's The Accidental Investment Banker, inside the decade that transformed Wall Street. This journey takes you through the dazzling heights of Wall Street, the remarkable change in investment banks' core values, and the shift from relationship-based banking to transactional approaches. The once conservative, trusted advisors turned into opportunistic deal-makers, captivated by skyrocketing IPOs and mergers and acquisitions. Delve into the inside story of Wall Street's most influential investment institutions, such as Goldman Sachs, Morgan Stanley, and Merrill Lynch, as they embrace the promise of unbridled wealth in a rapidly changing environment.
Remaking of Wall Street. Wall Street in the 1990s experienced a period of historic economic growth, during which America's top investment banks, such as Goldman Sachs and Merrill Lynch, each handled M&As valued at over $1 trillion. However, this period also saw drastic changes, as Wall Street's core values transformed in the face of too many profitable opportunities. The investment banks shifted from valuing exclusivity, integrity, and conservatism to becoming transactional and opportunistic, seizing countless lucrative IPOs and M&As. These were often high-tech firms with no business track records. Investment bankers built their reputations on client service and good business, transforming into superstars in the celebrity CEO era. The government also deregulated the banking environment, and commercial banks began engaging in investment banking activities with a newfound fervor. This period was a time of both great prosperity and major changes that would ultimately have long-term implications on the industry. The evolution of investment banking. Investment banking has changed significantly since its inception in the late 19th century. The top investment banks, including Morgan Stanley, Goldman Sachs, Merrill Lynch, First Boston, Lehman Brothers, and Donaldson Lufkin and Jenrette, DLJ, initially sold financial counsel to CEOs. However, they now focus on securities trading and sales, primarily IPOs, and M&As. IPOs and M&As became the most profitable activities for investment banks and other financial firms, and these firms also began dealing with speculative securities called junk bonds. The bankers of the past would have been appalled at the changes in their once pristine sector. Investment banking made simple. Investment banks are mainly involved in corporate finance and sales and trading. They help companies raise capital to expand operations, develop new capabilities, and purchase new assets through IPOs or sales of bonds. Investment bankers also provide objective advice on M&As and other transactions. As for the sales and trading function, the bank acts as a middleman in buying and selling securities. Investment banks earn up to 7% of the funds raised through IPOs. Investment banking, from trusted advisors to mercenary guns. Investment banking once operated as a model financial industry that provided wise counsel and superb execution. CEOs turned to investment banks for access to expert and objective financial advice they often did not get from insiders. However, during the 1970s, investment banks began to pursue M&As as a higher margin business, which transformed the once elevated importance of relationship banking forever. Investment banks started marketing dubious financial products that might be inimical to their clients' best interests, and the old reliable bankers were replaced by unorthodox M&A specialists who operated as mercenary guns for hire. As a result, among CEOs, there is now an unprecedented level of cynicism, suspicion, and distrust of investment banks. The rise and fall of Morgan Stanley. Morgan Stanley, once a part of the patrician House of Morgan, became a leading investment bank after spinning off from J.P. Morgan in 1935. Offering financial advice to powerful corporations worldwide, the firm was immediately successful, underwriting 25% of the market in its first year. By the 1950s, Morgan Stanley was the trend-setting firm in investment banking. However, In the 1960s, the company did not engage in securities sales and trading due to considering those activities déclassées. Despite this, in 1971, it entered the business of securities sales, trading, and mergers and acquisitions. In 1986, the White Shoe firm went public, and in 1997, it merged with Dean Witter Discover, a retail brokerage and credit card firm. Management turmoil temporarily damaged its reputation in 2005. The rise and success of Goldman Sachs. Goldman Sachs, founded by German Jewish immigrant families in the 19th century, emerged as a challenger to established Yankee houses. For decades, the bank stayed within the family before introducing partners not named Goldman or Sachs. During the IPO and M&A boom, Goldman structured itself differently, with its internal investment banking services department handling all client relationships. This model proved successful, enabling Goldman to quickly replace bankers and remain the leader in IPOs and M&As. Goldman's strength became prominent when it was hired to defend against hostile takeovers on Wall Street. However, in 1994, it suffered major fixed-income trading losses, leading to partner retirements and impending IPO. Nevertheless, Goldman became the Rock of Wall Street, continuing as the strongest franchise in investment banking. Investment banking in the 21st century. The burst of the high-tech and internet bubbles caused a significant retrenchment in the investment banking sector in the early 2000s. Investment banks' underwriting practices shifted from underwriting equity offerings for public benefit to underwriting issues for selling them at a set price. With hedge funds and LBO firms taking up investment banks' old role, investment banking no longer holds its former elevated status. While investment banking rebounded in 2005 with $20 billion in Wall Street payouts, many now view it as a commodity service, with potential long-term implications for the economy's risk profile due to the shift to less regulated institutions.
As we conclude our whirlwind tour of The Accidental Investment Banker, it's clear that the Wall Street of the 1990s experienced dramatic transformations in both values and approaches. Investment banks shifted from conservative, steady, and strong relationships to transactional, opportunistic, and short-term thinking, driven by the unprecedented profit potential of IPOs and M&As. Icons like Goldman Sachs, Morgan Stanley, and Merrill Lynch adjusted their models and strategy to stay competitive and adapt to these changes. The impact of these shifts can still be felt today, as investment banking's once prized reputation has been replaced by a more commoditized view of the industry, and less regulated institutions like LBO firms and hedge funds have risen in prominence. The lessons from this era remain an important reminder of the power of core values, and the potential consequences of trying to keep up in a fast-paced, ever-changing financial world.